Hello everybody, it's Greg here from Rugosa. Welcome to the channel, and I hope to earn your like and subscription today. Let's turn this down a little bit. There we go. Okay. This is the first video in what I am deeming the FinFluencer Woodchipper. Now, one of the promptings that got me to start this channel in the first place was I thought there needed to be, some honest to goodness, real speak from somebody that's actually putting capital at risk in the markets here to help new bros, trade or to provide some entertainment to the vets, stuff like that. And I hope you're enjoying it. I'm not here to dunk on anyone's hustle too hard, and definitely don't take this personally. It just is what it is. Okay, here, let's, so I came across this one video from this fellow, Juviers or Juvier Gems. I don't know. Sorry if I mispronounce your name. This guy seems friendly. I mean, seems personable. But what caught me here was live day trading, making $10,860 in brackets beginner strategy. So I'm thinking, wow, that's a decent amount of cash. So, I watched the video, and let's just listen to what he has to say here. How's he setting this up?
For buys off of here, but didn't give an entry. We could possibly it's actually setting up to do it right now. We could actually get a London breakout set up here if we're able to get price to buy above here. Hold on. Only thing is, I'm a little bit hesitant because we are pretty bullish on the 5-minute time frame. 1 minute we are chopping, which is what I do like to see. Yeah, I might take a London breakout if we get one. I think to the upside here, because we have crossover the EMA as well, which is nice. But it is selling down. I'm just going to set my stop order up here, just in case price wicks above here. If it wicks up here pretty fast, at least it'll get me in the trade. So all I'm looking for right now is a break of this London high, which is right here at the 29174 areas. And then we're going to hold this for a 2-to-1 if it gives this entry.
Stop filled.
All right, so I'm in this. Stop loss is going to be below this candlestick right here. We're going to go for a 2-to-1, which comes out 229,263. I want to continue to see this volume to the upside. Preferably, we get price to close above the London high, which is right up here. It's wicking off of it. This is not a good sign. We're down about $1,000 right now.
All right, that's about all we need to see to figure out the rest of where we're going. I'll keep it up in case I want to refer back to it again. Now, before I start to break down his trade, I just want to give some insights. So this fellow here, at the end of the video, he's asking, join my premium Discord, have me for trading mentorship. That's his hustle. Everyone's got a hustle. You do what you got to do. You know what? I'm going to throw my own hustle out there. If you guys help the YouTube subscription, because apparently if I get enough subscribers, I can get YouTube money, then we're going to YOLO that, because do I look like a Voo and Chill dude? Come on. So, yeah. Help me create more content through YOLOs. Anyhow, there's my plug. Don't murder me for it. Now, back to the brass tacks. A London Open breakout. Is that a thing? Yeah, I know. Theoretically it is. And he's looking for 2 to 1, blah blah blah. What does that mean? I mean, I have no clue. I know that people put that as like some kind of mathematical type thing on how to risk balance a trade. Let's look at what he actually bagged. So he says 10 860. Now he threw 6 lots of NQ. Okay, so that's 1810 per lot. And how many points is that? Because they're $20 points. He just looked to bag 90.5 points off of his trade. Now he sat there and he sweated out for quite a while. Let's look out on the chart here. He entered what time was it? It was right around here. So I mean, like, yeah, did he get a good fill? Yeah, he got a good fill. Like, I mean, hats off to him. He made some cash here. He had to ride this thing up like almost 9/10 to book what he wanted to book. And he's calling this a beginner strategy. Now, for you actual beginners out there, let's go look at what this beginner strategy really means. Now, first off, it's a 6 lot of NQ. So NQ is right now, what it was like, let's just call it 2,900 or 29,000 flat, 20. Your notional per contract at 29,000 points is 580,000 US dollars. He was running a 6 lot. His notional was $3.48 million. $3.48 million. And he's saying this is a newbie trading thing, okay? That is absolutely nuts. Let's break this down into what the actual margin requirement is to hold this position. So to hold one contract right now, it's 38,065 US. He wants 6 of them. So he's saying a newbie stepping up to the plate, like this could be one of your first sets of trades. Maybe you've been trading a couple months, a couple of weeks, maybe you've been trading a first year. I don't know. But he's saying this is what you should learn on. This is what you should cut your teeth on. You should cut your teeth on slinging almost $230,000 of initial margin. All right. You know, that's... I like to take risk. My positions are effectively leveraged out 12 times. Like, I am running 120% or 1,200%, sorry, 1,200% on my netlick. It's a decent amount, but I'm definitely not telling you to go do something like this. Now, those are the raw numbers on this trade. Let's break down what the theory of this trade is. This theory is that the overnight session, particularly the London session, can tell you something about what's going on. I can tell you hands down, institutional traders basically do not care what happens overnight. You look at what happens overnight in other markets to judge the macroeconomic movement of global finance as a whole. Now, the volume here you can see overnight, right around here, this is about London sessions open. Now, I wish you could go and see what the actual volume is here. But between there and there, you know what? I would bet we are lucky. We are probably lucky to get 30,000 contracts, 30,000 lots get filled in that whole overnight session. What's happening in that overnight session is global institutions are hedging out their positions or taking positions in the NASDAQ 100, and this is just a low liquidity environment, and they're getting fills to manage their books. We can look out at here's a good thing. This gives you an idea on what happens globally overnight. This is coming up Tuesday. Okay, we've got 9 events happening. Early in the morning, it's 1 a.m. Chicago time. You have the labor market report in Great Britain. How does that affect the NASDAQ 100? I'm not entirely too sure, but it might. Then at 1:45 Chicago time, you have the French CPI report. How does that affect the NASDAQ 100? I don't know. And then you have at 4 a.m. the EU industrial production numbers. And then at that's 6:50 p.m. That's not even in the morning anymore. Okay. So, but that's overnight. So, the market's already closed, and this would be Wednesday then for Japanese machinery orders and Chinese GDP, Chinese retail sales, and Chinese industrial production. These economic reports and releases are going to go and give insight to what is happening in the market, and the futures are going to react to that. Futures are they're also going to really break down into what the foreign central banks are doing. So the ECB, Bank of England, Bank of Japan, People's Bank of China, here breaking it down into New York time. ECB releasing just before cash open at 8:15 a.m. Eastern time. Are we going to change rates dramatically? Is the Eurozone crashing? That's going to impact U.S. equities. Bank of England, 7 a.m. Same deal. Bank of Japan, 9:30 p.m., 11:30 p.m. Same deal. The yen dollar carry trade is a huge thing. Bank of Japan makes a move, there is going to be U.S. equity movement. And it has absolutely nothing to do with traders just, managing their positions in the overnight markets from London or during the London opening time. That's not how the game plays. What happens is the institutions, the big money institutions, they figure out what their positioning wants to be the day before, they do their research overnight, whatever. They check these economic releases. Is there any kind of fire that's happening? Any bombs that have dropped? Any literal bombs that have dropped? Is the Suez Canal closed? Did all the oil refineries in Kuwait and United Arab Emirates and whatever, did they all just get blown up by Iranian missiles? That's the kind of stuff they want to know. That's what's going to move the market overnight. Otherwise, it is just pure noise. Okay? Pure noise. Now, talking about this noise and what he just did, let's break this down. We all know the NASDAQ 100 is an index of the 100 largest tech names, right? I'm over-explaining stuff. Let's break this down into what this really means. So, about 12.7% is NVIDIA. A single lot exposure, $72,000 of NVIDIA. This dude in a 6 lot of NQ is slinging 2,000 shares of NVIDIA. That is going to really hit on AI news. Apple, he's on the 6 lot, he's essentially slinging 800 shares of Apple. CPI is going to impact him a lot, Amazon, same deal, CPI. Tesla might do a little bit. AMD, that's a little bit going to be probably a little more industrial. Microsoft, maybe a little bit more, goodness, I don't know, global macro, whatever. I'm not a global macro guy. I'm just telling you, this is what he is literally trading. These number of shares in this lot. What does this mean? Why am I showing this to you? I am showing this to you because the total slippage of Citadel when Citadel is, making the markets and all these underlies, they need to hedge out their gamma exposure, their Vega exposure. They're not hedging Vega, but they need to zero this stuff out on the books. Okay, so on the estimated slippage or their estimated spread capture on that number of shares On the top 10 components, he just handed Citadel a free $166. If you look at over the entire basket of the NASDAQ 100, with the aggregated friction of just making markets, he handed Citadel a free $382.14. He's thinking he's getting a nice fill in NQ when he just paid Citadel, $380 to zero out their risk, assume all downside risk, and it's a lot. So, I'm throwing a lot of shade at this guy. How do I think it could be done better for a new bro? Well, let's break this down. So we already know that he's looking to capture about 90 points. Now, here, I'm looking at NQ, or MNQ, but let's look at NQ. Now, this is the weekend. It's Saturday right now here, so unfortunately the bids are absolutely terrible. Let's see if MNQ can give us some better data. I think MNQ gives us some better data. Those seem to be a little bit more tighter, more reliable numbers. When we look at NQ, it looks like these things have just blown right out for the weekend for the last few prints. So we're going to base our numbers off of MNQ, okay? Now, this is not how you really do expected move. An expected move is an average of strangles within your time frame. But for back of the envelope, just doing something quick and dirty, running the at the money straddle, and using that premium to judge your expected move, it's good enough. Good enough for the girls I go out with in government work. So let's assume that mid price, what could we probably get filled at? 370? Does 370 sound right? Let's go. Yeah, let's say 365. 365. So it's 365 points in there, and he only needs to collect 90. Oh wait, 90 divided by 3. So out of the entire move, he is looking to capture roughly 25% of the day's expected move at open. This is what the market is actually looking at. They're not looking and they're not caring what closed it, what happened in London, what happened overnight. They don't care. They're looking at this number right here. 365 points of expected move in the day, and he doesn't know it, but he's trying to capture 25% of that expected move. Let's look. So we say that he's got in, let's say he got in at 2,900. Actually, I don't know where he would have gotten out at. Maybe he got in here. No, he said that he got in at London highs. He was looking for the London breakout. So that should put him... Yeah, that should put him here. Okay. So... he's looking... Did he get out there? Where was it? Let's say this is... What? 29,170. And let's painstakingly move this up to 29,260. Right about there, about 1/3. 1/3 point. All right, a little baby scalp. Okay, whatever. But he's putting basically $3.5 million on the line here to get this thing done. Now, did I complain a little bit about giving up some cash to Citadel? Yeah. But you know what I hate the most? I hate it when you just give them stuff for free. You're not running a business. You're stepping up to the casino and you're putting your money on black. Is there a time and place for that? Yeah, sure there is. Is telling the new bros this is how you make this is how you make a living trading? Is this the time and the place? No. In my mind, no. This is not how you do it. But we're gonna say we want to try to teach the new bros how to capture 90 points in the NASDAQ 100. So how can we do this? How can we replicate his strategy a little bit smarter here? Because I don't want to just throw shade and walk away. I want to give you some value. So here we go. Let's build out something here. Where can we get? You know what? This seems good enough. 35 delta. Maybe we can get that thing filled for 90 points. I would say so. I mean, I don't know. You could probably get that thing filled for 100, but 90 seems good enough. So you got that. Now, if you're running in the NQs, mind you, that is a big contract. The small contract is already chewing up. Well, on my screen, it says in Canadian dollars. Let's give you actual numbers here. Okay, so the big contract is holding up 38,000 US. The small one should hold up 3,800. Let's just micros. Let's just double check, because you know what, 3,800 is what I said the margin should be, roughly. Yeah, and there you go. It's like 10 times less, because it's 1/10, or 10 times less because it's 1/10 the size. Yeah, because I can do math. Anyhow, that's what we're looking at. Is this something a new bro can do at size? You know, this could be a pretty decent size. Now we can adjust this in span margin and stuff like that, and reduce your actual margin impact with trade structuring. But in order to structure this and fit this into a small account, we might blow any kind of edge that we might have. So keep that in mind. Right here, we're just trying to capture 90 points. And if you don't want to do that by putting basically 40 grand at risk, and you only want to do 4,000 at risk, here's how we can do it. 4,000 at risk, we can pick up a couple shares here and there if you want. If you want to dynamically delta hedge this, like Citadel would. Let's pull up the. If you wanted to pick it up like Citadel. Goodness. I don't want to do that. I should have had Gemini make that thing with the smaller. Whatever. You can look at this and say, oh, cool, I guess, you know, it's just 6 times less. This is 1/6 of that. You know, you're going to go out there and you're going to go to the market and you're going to say, hey, if I want to statistically zero out my Apple exposure, I need to pick up like 105 shares of Apple. 105 shares of Apple is just going to destroy your capital efficiency in a small account under Reg T. So this is why we're slinging futures. Next week, I think on Monday, on the 27th. Yeah, on the 27th, this coming Monday here, we're gonna get single stock futures in 100 share equivalents and 10 share equivalents, which will be amazing. If you want to run a strategy like this and dynamically beta weight your delta hedging, I think that is an awesome beginner strategy. Now, I might have a different definition of a beginner from this guy, but here on this channel, you either keep up or you get out. Like meteorocracy. Yeah, that word, you know. Cream rises to the top. So anyhow, we're looking to pull 90 points off. We want to limit our upside exposure. I don't know, what was this guy's stop loss at? Did we find out? I think he said it. Right there.
Above here. If it wakes up here pretty fast, at least it'll get me in the trade. So all I'm looking for right now is a break of this London high, which is right here at the 29174 areas. And then we're going to hold this for a 2-to-1 if it gives this entry.
I went back a little bit too far.
All right, so I'm in this. Stop loss is gonna be below this candlestick right here. We're gonna go for a 2-to-1, which comes out to.
Oh, that gave us like absolutely no information. Okay, let's try to. So he was like 174 is what he said, and he wanted it to be below that. So let's say he's taking 40 points of heat. I guess that could make sense. He wanted 2-to-1. Yeah, 40 points, 45 points of heat. What does that look like here? Let's do this the smart way. This is the wonderful thing about call scalping. We go this far out, we can't pick up that, but you know, pick up a lot more risk. You know what? The 65 is okay. We're, you know, if we're on a quick interday type of thing, there are no fills on there, no quotes. Where can we go? Can we go there? Nope. Can we go there? Nope. Can we go here to the monthlies? That is still the same contract. Yes, that is all right. So we can still use the same actual strike value. Keep that in mind. Strike values change when the contract changes. And we're looking at 45 points of heat. So let's just call that 50 because math sucks. And strikes don't break themselves out that way. And 45 points in this market, they go by 50s or 100s, or 25s. And can we get 28.5? No, we can't get 28.5. We'll have to go to there. So let's just try to define the risk the way that he wanted it to be defined, and let's try to do it in a way that is a little bit smarter than your average bear. That's what we're trying to do here. We're trying to be a little bit smarter than your average bear. Okay, we can take out this one. 28,475 and 28. Yeah, okay, so we're taking 25 points of heat. We're actually taking less heat than he is. A 41 DTE. Okay. And okay. Now, we're looking at this here. What we've created here is a calendarized call. I mean, it's technically a calendarized call debit spread. The debit part being you had to pay to get in rather than a credit with getting paid or collecting positive cash flow to get in. That is not the right way to think about this trade. The right way to think about this trade here is we are selling front month volatility, expected move, essentially being at the 35 delta is pretty much the daily expected move. I mean, the expected move could be a little bit more or something like that, but you know, it's close enough. It's kind of okay. Okay. Now, since we're picking up about what we said, 90 points on that, can we push this out and get a little bit nicer? No, we can't. All right, so we're just gonna sit here. Okay, we can do that. If you could, and you could not, because if you saw my video from yesterday where I was fighting for like 40 minutes to get a fill, you can't get a fill on this thing, so you're probably gonna have to get it filled at the worst prices possible. But is what it is. For academic purposes, let's say we're gonna get it filled right at mid. So what would mid price be? 600 to 922. So that's 172. What is 1/2 of 372? No, sorry, that's 322. That's one. Yeah. Okay. So that is 770. Let's say 770. Does it really matter? I don't know. Instead of just trying to break down this math, let's explain what's going to go on and what's going to happen. We are going to hold this long call to just provide a straight up hedge because we want to have the same risk profile that he does, and we want to do it in a smarter manner. Okay, so we want to cap out our risk, and we're looking to collect those couple points. Now we're giving ourselves essentially 38 days of deltas, 30 days of theta, sorry, to just systematically push this short call forward and collect premium on the position. And we've capped out our upside risk at roughly the same amount of point loss that he did, except he is accepting downside exposure on his position, and we are limiting the upside blow up. So we're flipping around what our risk profile, our directional risk profile is looking like, and we're looking to collect some cash. Now, when you close out this is going to essentially be a 0 DTE short call. You probably want to close out the long leg at the same time too, accept some slippage. That slippage, though, keep in mind, in these markets, they are huge. They are very, very wide. So that might eat up all your profits. Maybe that's not why you want to do it. Do I want to tell a new bro that you should dynamically hedge your deltas? Yes. Yes, I do. Do I think a new bro can stomach doing that under fire in the market? No. No, I don't think you can. But this is kind of what we're looking at. And having this being very close, it'll really shield close to at the money, or basically at the money. We're at the money here. It's going to pick up a lot of gamma very quickly, and being out in essentially the 1 month cycle, it is at the peak of the volatility curve. So if the NASDAQ 100, if NQ experiences downside move, it is going to increase the IV in the chain, which will in turn keep the call premium slightly bid. So we're going to get a little bit of relief on that, but I really wouldn't count on it. Now also look at how things went on the position. I mean, if you would have held that long call, you would be down like what, 3.2, 3.25, something like that. Great way to lose cash. But it is what it is. What I would roughly say it'd be a way better way of doing this, instead of trying to get a directional hit the way that he's getting it, and instead of trying to really balance out your absolute defined risk metrics that way, just pony up to the bar a little bit, and let's try to dynamically reduce our Greeks. How does this look? Well, we want something that has a lot of vega sensitivity and some pretty decent gamma sensitivity, because if we're shorting the front month, or that day, very short time frame contract, we're going to get a lot of gamma sensitivity. This guy's whole trade, Juvier's trade, is just basically running with gamma. Now, it's unfortunate that he doesn't tell us how he got this thing set up. From what I can tell, he's just looking at London high, London low, and thinking that if there's enough volume and enough buying pressure to push it past that, it's going to continue. I think he said that, like a continuation trade. That is not how the things work. There are pockets of gamma that push and that act as like magnets in the market, and he's relying on these magnets without showing you what these magnets are. I will show you what these magnets are. Let's look Because having actual market information is better than not having market information. Let's look at what some of these actual magnets are like. Why are there like no open interest on this? This is the big contract. Wow. This is a ghost zone. Okay, we're going to ES. Ghost Town. Bum ba-dum ba-dum. Weeklies, quarterlies. Let's go up 2-day. All right. Pockets. Maybe I was looking at the wrong thing. Let's just double check. Sometimes I do that. No. There's like no open interest. None. Like it doesn't even exist. Okay. These volume numbers here, they're going to turn into open interest, but there's a nice little pocket of gamma. Excuse me. Those are a bunch of folks that 75.50. Those could have been legacy positions from way out, and then the almost 6,500 lots that moved through. Interesting. But this volume here, these are creating gamma pockets, and this one may or may not be hedged out. This one will not be hedged out. Citadel and Jane Street and those guys, they'll start slowly picking up deltas based off of gamma and the rate of change of gamma. Gamma being the rate of change of delta, but the actual rate of change or the rate of change, like the gamma acceleration, is kind of really what they're worried about. Because they don't want this thing to run away on them and they don't want to get squeezed. So that is going to be an indicator for them to determine if a squeeze is happening. So, they kind of want to pick it up, but they don't want to pick up too much deltas because they still want to collect a lot of cash, as much cash as possible. And us, as being liquidity providers in the market, rather than Juvier being a liquidity consumer. Now, him having a resting order there, he is technically providing liquidity to the market, but in his actual trading and how it's working, he is consuming liquidity rather than providing it. Is consuming liquidity the same way a pension fund or a wealth manager is buying shares of stock for a retirement account. It just so happens that his account has a time frame of minutes instead of decades. Citadel has no idea who is buying what. For them, it's all the same. But anyhow, these little pockets here of gamma are things that need to get hedged out, and you can see market can really rip up to these numbers. And then is it really going to go much higher? This is on Monday. Okay, guys, Monday. Are we really going to see 75.70 on Monday? 75.70 on Monday would be 125 point rip. Is it possible? That's totally possible. That can actually happen. Market is saying no, that's not. Market is saying our back of envelope. I like taking the most expensive ones. Because I like being as conservative as possible. Market is saying the expected move is like 53 points. So we're looking at something that's like basically 2.25 times the expected move. that is why you see these things trailing out. Because people don't want to buy this far out. That is a full-on black swan event. That's like I think 2.5 deltas, if I remember right. Correct me if I'm wrong. I think that's about a 3 sigma. 1 sigma is 16, if I recall. 2 sigma is 5. So yeah, what were we talking about? We were talking about gamma. Yeah, so those little gamma pockets, that's what we need to work out on. Be careful about. So we need to pick something that's going to still have some gamma sensitivity on our MNQ trade and still, kind of protect us here. We go down and there's like no market. Nothing. Look, it doesn't exist. And we're in an actual monthly contract. This isn't a weekly. Okay. You can't even set up this trade realistically. You're gonna get murdered by the bid ask. Let's change gears here, and instead of trying to sling this thing in the NASDAQ 100, I don't know why guys love the NASDAQ 100. To me, so much of the math and so much of the market operates off of the S&P 500. Oh, might as well just use that. It's good enough. It's got basically all of the NASDAQ 100 in it anyways. So we were looking at like a 3.5 delta or 35 delta. Okay. And let's go pick up some insurance for us here. That strike. We're double check your contracts. Are we the September contract? We are in the September contract. Is that one September? That one is September. You don't want to get caught out because your contracts are off. That right there is a rookie mistake. Okay, so 74.75. 74.75. That is right there. If you take that is a full-on traditional calendar spread. Chances are this is going to be very hard to make money in because you're not making the Greeks fight one another and trying to find friction within the market. What you're doing is you're making a really nice risk profile that can be really easily mathematically modeled, and there may not be any alpha to capture in that. You might have to do some actual math to figure it out. So for me, guys like me, leave that for the quants. Just leave it for them. What we know though is we can look something else out. If we want to be really risk averse, the 30 deltas are going to help us out a lot. 16 deltas may not actually be hit. 16 deltas will have a 30% probability of touch within the contract life cycle. The probability of touch is roughly twice the delta, for your information. So if you look at the money at 50 deltas, your probability of touch is 100. You know what? I would say a half decent price or place for taking some tail risk insurance might be your 10 delta. So pick it up there. And then let's say you're a little concerned, you're a newbie, and you don't want to you want to play things a little bit safer. You want to run a trade that's kind of like this, but the waters feel scary, and understandably so. Okay, so what do we want to do? We want to let's pick up some convexity. Let's pick up something that is not necessarily going to be a hedge that we're relying on, but something that's cheap enough that if something moves against us, it's got the sensitivity to give us some cash to maybe cover a roll cost or something like that. When you're rolling, you want to be rolling for credits anyways. But that's kind of what we're looking at here. So if you look out here, EX1, because right now we can't even trade the cash settled options. Let's pick up something for some convexity. We could pick up another 10 delta if you want to pick up another 10 delta. But if you want to be a little bit more cash conscious, let's say, nothing wrong with that. This is basically 5 delta. That could do it. In a big move up, that 5 delta is going to just explode in value. And how does this look? This looks like 7710. 7710 isn't that far off. Let's look at a little bit of a longer chart here. So all-time high, which I think is right there. It may not be. If it's not, whatever. It's close enough. We're above all-time high, but we're not that far above. We're only, what is that, 90, 80 points above that. That'll pick up in value right quick. So you could do something like that. Something like that. It's up to you. It's up to you to figure out what risk you are comfy with, and you live with that. You need to be able to sleep at night with this stuff. If I was Juvier, I would not be able to sleep at night running a 6 slot and just assuming that my stop loss is going to bail me out. Big thing, guys, stop loss is not risk management. Stop losses turn into market orders once they sit on your broker as a place to fire off a market order to close or zero your position. Okay? Now, if the market turns violent, that's not going to be executed or filled in an orderly manner. You have no idea where that is going to be filled at. It is not reliable. It is not proper risk management. I'm going to say it again. Stop losses are not proper risk management. Gaps do happen. They do. A little bit of lore. I was working at a volatility fund, and our stop losses on the Swiss franc were gapped during Swiss central bank changing the pricing floor on, or like the pricing stability between the franc and the euro, and that we're using it as a hedge and had a stop loss on to protect the position, and that stop loss got gapped, and that created a significant issue for the fund strategy, because that was our hedge and our hedge didn't work out, and all of a sudden it's not hedging anymore, and instead of being a place where you could rely on for risk to be taken off, it now added and compounded our risk. So be careful. Anyhow, a little bit of a rant. This could be okay. So how would I trade this? This is a 3-legged combo. You don't have to route this all at once. You route this all at once, you're gonna get just killed on trying to get filled. So I would first off start with my insurance. Start with the 7,800. Call in the monthly. Pick that up. Pick it up for like 12 points. 12 and a quarter. I don't know, something like that. Try to get it filled. Try to get it filled for something good. Then work on selling your front month, your 0-day call that you're going to collect your premium on. Maybe you get that thing for 12 as well too. And then because you want to have a little bit of, you know, extra sleep at night insurance, look on getting your third leg filled, and there you go. That third leg, when you close out your short position, look very much to close out that third leg. Your long-term insurance is something where I'm assuming you're wanting to be running this as a business, so that is your cost of keeping your doors open. Trying to trade a London breakout strategy is not running a business. You are literally just being a participant at the casino. And any of you guys can come and try to call me out in the comments for that, and I'm going to stick to my guns. If you're just trying to go and trade directionally like that in the futures, you are a casino participant. You are not a market participant. You can be a person that assumes risk, assumes directional risk. But if you do not do it in a systematic way that can be replicated day in and day out, or quarter in and quarter out, or through specific setups, like event-driven things like FOMC or CPI prints or something like that, you are coming up to the casino. That's a hill I will die on. Anyhow, here, this is a long way for me to try to protect you or tell you guys how to do something. I hope you found some value from it, and I hope you have a good rest of your weekend. Here, where is the button to close this thing out? Oh, wow, we're like almost 52 minutes. All right, well, thank you for stopping by. Have a good one.